Trusts have long been a pillar of estate planning, offering control, protection, and powerful tax advantages when used correctly. But with ever-evolving tax rules and stricter reporting obligations, many high net worth individuals and families are asking, are trusts still worth it? And the answer is yes, but only if you understand how they work, you stay within the rules and manage them properly over time. So in this video, we'll explore why trusts are used in modern estate planning, how trusts are taxed, including the periodic and exit charges, the importance of the Rysaffe principle and how changes affect planning today, and how to keep trusts effective for the long term. So if you're looking to protect family wealth, avoid inheritance tax pitfalls, and ensure your money benefits the right people at the right time, this video is for you. Hi, I'm Carl, and if you're new here, welcome to the channel. I'm a regulated and practicing chartered financial advisor, but in these videos, I'm not providing financial advice. The topics discussed in these videos are just for guidance and for you to do your own research on so you can make your own decisions. While the technical setup of a trust can seem complex, the motivations are usually simple. People use trusts to protect wealth, control how it's passed on, and reduce future inheritance tax exposure. Here are two of the most common reasons. So firstly, we've got bloodline protection. So this involves placing assets in a trust and ensures that wealth stays within your family, rather than gifting assets outright where they could be lost to divorce, remarriage, or poor decision making. A trust ring fences them. The trustees control how and when the money is distributed. This is especially valuable if you want to protect children but protect against future ex-spouses, or a beneficiary is financially immature or vulnerable or at risk of being influenced, or you want to preserve capital across generations. And a second reason for trusts is the inheritance tax planning. So trusts can help mitigate inheritance tax, especially when set up correctly during your lifetime, because assets placed in most lifetime trusts are subject to inheritance tax charges, but with good planning, these charges can be minimized or avoided entirely. By moving money into trust gradually over time, rather than leaving it all at death, you can reduce the size of your estate and take advantage of individual nil rate bands effectively. It's essential to understand how trusts are taxed in the UK. There are three main areas to be aware of. Okay, firstly, we've got the initial charge on lifetime trusts. So when you set up most types of lifetime trusts, such as a discretionary trust, you may face an entry charge if the amount settled exceeds the available nil rate band, which currently at the time of filming is £325,000 per person. This charge is typically 20% on amounts above the nil rate band when the trust is created. And secondly, we've got periodic or 10-year charges. So every 10 years, a trust may be subject to a periodic charge of up to 6% on the value of the trust above the available nil rate band at that time. The actual rate is usually lower after deductions and reliefs. Now, this 10-year charge applies regardless of whether income has been paid out or not. It's based on the value of the trust at that date. Okay, and thirdly, we've got exit charges. Whenever assets leave the trust, e.g. when distributed to a beneficiary, an exit charge may apply. Typically a proportion of the 6% rate based on how long it's been since the last periodic charge or since the trust began. Okay, fourthly, we've got ongoing income and capital gains tax. Trusts can suffer high rates of both income tax, because trustees pay 45% on most income and dividends are taxed at 39.35%, unless the income is mandated to beneficiaries. Capital gains tax, trusts have a smaller capital gains tax exemption, which currently at the time of filming is £1,500, and pay 20% or 28% for residential property on gains. And this makes it crucial to think carefully about what investments are held within a trust, and we're going to discuss more on this later. The Rysaffe principle was named after a legal case in the 1980s. It made it possible to create multiple trusts on different days, each with its own nil rate band. So the old strategy until 2006 was a powerful way to spread inheritance tax planning using multiple trusts and multiple allowances. But what changed is from 22nd of March 2006, all new relevant property trusts created by the same settlor are grouped together for inheritance tax purposes if money is settled into them on the same day. So this effectively stopped the multiple nil rate bands in one day strategy. But crucially, it didn't stop the strategy altogether. So this is how to use it now. So if you stagger the creation of trusts, and more importantly, the settlement of funds into these trusts across multiple different tax years or even just different days, the Rysaffe principle still applies. So each trust gets its own entry allowance up to the nil rate band, separate periodic and exit charge calculations. So if you're planning to place significant wealth into trusts, you could create one trust this year and then potentially create another the following year or the next day, depending on your strategy. You could use your nil rate band again if 7 years have passed since the first gift, assuming no other gifts or chargeable lifetime transfers. This is particularly powerful for clients in their 50s and 60s who want to begin gradual wealth transfer without facing big inheritance tax charges up front. Now, even the best structured trust will fall apart if it's mismanaged. The key to making trusts work for you long term is not just tax efficiency, it's the governance and investment strategy. So you've firstly got to get the right trustee structure. Trustees have a legal obligation to act in the best interests of all beneficiaries. A strong trustee setup means that everyone understands their roles and responsibilities. The decisions are well documented and regularly reviewed. Trustees should know how to interact with professional advisors, and these could be legal advisors, tax advisors, or even investment advisors. So a tip here is to get the family members involved early. Even if your children are not yet ready to be trustees, involve them in the discussions and consider appointing them as trustees when appropriate, because this will help build the continuity and understanding of the trust longer term. Having at least one professional trustee or an advisor experienced in trust administration can help keep the trust compliant and forward-looking. The other big thing for making these trusts work is to choose tax-efficient investments. As we've spoken about earlier, trusts are taxed harshly on income and gains. So the wrong investment approach can erode the value of the trust over time. So suitable investment options might include growth-focused assets with low income yield. So this would be accumulation funds or growth stocks. Investment bonds, especially offshore bonds, as they allow trustees to defer tax until encashment. And even then, tax may be borne by the beneficiary if assigned correctly. So tax-efficient funds or trusts that roll up returns rather than pay out income. You really need to avoid placing high dividend funds or rental property into a discretionary trust unless there's a clear rationale, because the tax leakage can be significant. Also ensure that trust investments align with the letter of wishes and the needs of future generations. Long-term planning needs long-term thinking. Despite tax tightening and regulatory burdens, trusts still offer long-term control and protection from financial threats, and the potential for inheritance tax mitigation when planned carefully. So the key is to act early, plan strategically, and manage proactively. Trusts are not a set and forget solution. They require ongoing input and review. So if you want to make sure your trust does what it's meant to, protect your family and reduce tax, it's worth taking specialist advice. Now, I hope you found this video useful. If you have found some value in it, please give it a like. And if you haven't already, please subscribe to the channel, as we've got lots more wealth management strategies coming soon. Until next time, take care.